Most beginner traders do not lose because they always choose the wrong direction. Many times, they actually understand the market direction correctly. They see that the market is going up, they understand that buyers are strong, or they see that the market is going down, they understand that sellers are in control. But even when the direction is right, they still lose money. Why? Because they enter too late. This is one of the most common trading mistakes beginners make. They do not enter when the opportunity is forming. They enter when the move is already obvious. They enter after the big candles. They enter after the excitement. They enter when the price has already moved too far. And when they finally enter, the market pulls back. Then they ask, "Why did I lose if my analysis was right?" The answer is simple. Your direction may be right, but your entry may be wrong. In trading, being right about direction is not enough. You also need good timing. You need a good entry price. You need enough space for the trade to move. And you need to avoid chasing the market. Chasing the market means entering a trade after price has already made a strong move, only because you are afraid to miss the opportunity. This usually happens because of FOMO, fear of missing out. The trader sees price moving fast and thinks, "If I do not enter now, I will miss the trade." So he enters quickly. But many times he enters exactly when the move is already weak. Now let's make this very simple. Imagine the market is moving up from a strong support level. At the beginning of the move, the price is still near support. This means the risk may be smaller. There is more space for price to move upward. Professional traders may already be watching this area. They wait for confirmation. They look for structure. They look for a clean entry. The chart now shows the price beginning to move upward from support. First one green candle appears, then a second, then a third, each progressively larger and more convincing. A red entry arrow appears on the chart at the third candle, the beginner's entry point, well above the support zone. The chart clearly shows the entry happening after the move has already developed. The camera slowly zooms in on the entry point, highlighting the late timing. But the beginner trader does nothing at first. He is afraid. He is not sure. He waits. Then price starts moving higher. One green candle appears, then another green candle, then a third strong candle. Now the beginner feels confident. He thinks, now the market is clearly going up. So he enters a buy trade. The chart zooms out slightly to reveal a resistance zone above the entry point, a red or orange shaded horizontal area. The entry arrow is now clearly visible between the support zone below and the resistance zone above, with very little space between the entry and resistance. Price begins to stall and form small red candles near resistance. The visual clearly shows the problem. The entry is too close to resistance, with minimal room to move. A subtle label reads, resistance zone. But here is the problem. By the time he enters, price may already be close to resistance. The market has already moved. The opportunity is no longer fresh. There is not enough room left. Sellers may appear at resistance. Price may pull back. Medium shot of the trader at his desk, looking at the screen. His expression is quiet disappointment. Not dramatic, but genuine. He leans back slightly in his chair, one hand resting on the desk. The monitor behind him shows a trade in the red. Price has reversed below his entry. The warm desk lamp casts a soft light. The shot is calm and observational, capturing the emotional reality of a late entry without exaggeration. And suddenly, the beginner is trapped in a bad entry. The direction was right, but the entry was late. Now let's look at the opposite example. The market is falling from a strong resistance level. At first, the beginner does not enter. He waits because he is not sure. Then price starts dropping. One red candle appears, then another red candle, then a large bearish candle. The chart now shows 3 strong red candles having formed, a clear extended downward move. A red sell entry arrow appears at the bottom of the 3rd large bearish candle, the beginner's entry point, well below the resistance zone. Below the entry, a support zone is visible, a blue or green shaded area. The entry is clearly very close to the support zone, with minimal room to fall further. The camera holds on this chart, allowing the viewer to see the problem clearly. Now the beginner panics. He thinks, "The market is crashing. I must sell now." So he enters a sell trade after the big move. But price is already close to support. Buyers may appear. Price slows down. Then price bounces up. The chart continues to show price reaching the support zone and then bouncing upward. A series of green candles forming after the support level. The sell entry arrow is now clearly below the current price, showing the trade is in a loss. The visual tells the complete story. Sell entry too late. Price bounced from support. Beginner loses. Camera slowly zooms out to show the full picture. Resistance at top, support at bottom, and the late entry caught in between. And the beginner loses again. Not because the market idea was completely wrong, but because he sold too late. This is why late entries are dangerous. A late entry gives you worse risk. A late entry gives you less reward. A late entry makes you emotional, and a late entry often puts you near the end of the move, not the beginning. The market does not reward you for entering fast. The market rewards patience, timing, and discipline. Now let's talk about why beginners enter too late. Reason number 1, they wait for too much confirmation. Confirmation is important, but if you wait until everything looks perfect, the move may already be finished. Many beginners want to see the market move strongly before they trust the trade. But strong movement can also mean the best entry is already gone. Reason number 2, they are afraid to miss out. When price moves fast, emotions become strong. The trader feels pressure. He feels that everyone is making money except him. So he enters without thinking clearly. This is not a trading plan. This is emotional reaction. Reason number 3, they do not understand support and resistance. If you do not know where the important levels are, you cannot know if your entry is good or late. You may buy directly under resistance or sell directly above support. This is a big mistake because price often reacts from these areas. Reason number 4, they do not wait for pullbacks. A pullback is when price moves in one direction, then comes back slightly before continuing. In an uptrend, price does not usually move straight up forever. It moves up, pulls back, then continues. In a downtrend, price moves down, pulls back, then continues. Many beginners enter after the strong move, but better traders often wait for the pullback. Reason number 5, they trade without a plan. If you do not have a plan, every candle can tempt you. A strong candle makes you enter. A sudden move makes you panic. A missed trade makes you chase. But a trading plan keeps you calm. It tells you when to enter. It tells you when to stay out. It tells you where your risk is. Now let's learn how to avoid late entries. Rule number 1. Do not enter only because the candle is big. A big candle can show strength, but it can also mean the move is already extended. Before entering, ask yourself, is this the beginning of the move, or am I entering after the move already happened? A big green candle near support may be useful, but a big green candle directly under resistance can be dangerous. A big red candle near resistance may be useful, but a big red candle directly above support can be dangerous. Context matters. Rule number 2. Always check the nearest support and resistance. Before you buy, ask, where is the next resistance? Before you sell, ask, where is the next support? If the next level is too close, the trade may not be worth it. You need space. A good trade should have room to move before hitting a strong opposite level. If you buy too close to resistance, you are buying where sellers may appear. If you sell too close to support, you are selling where buyers may appear. Rule number 3. Wait for a pullback when the move is already extended. Do not chase price after several strong candles. Wait. Let price come back to a better area. For example, if the market breaks above resistance, do not always buy immediately after the breakout. Sometimes it is better to wait for price to retest the broken level. If the level holds as support, the entry may become clearer. This does not mean every pullback will work, but it can help you avoid entering at the worst possible price. Rule number 4. Use market structure. Market structure helps you understand where price is moving. In an uptrend, price creates higher highs and higher lows. In a downtrend, price creates lower highs and lower lows. If you want to buy in an uptrend, look for price near a higher low, not after price has already reached a new high. If you want to sell in a downtrend, look for price near a lower high, not after price has already dropped too far. This simple idea can help you avoid chasing. Rule number 5. Accept that some trades are missed. This is very important. You do not need to catch every move. If the move already happened, let it go. There will always be another setup. The market gives many opportunities, but your capital is limited. Protect your capital. Do not waste it on late emotional entries. Now let's compare two traders. Trader number 1 is emotional. He sees price moving fast. He feels fear. He enters immediately. He does not check support. He does not check resistance. He does not wait for a pullback. He does not calculate risk. He just wants to be inside the trade. Trader number 2 is disciplined. He sees the same move, but he stays calm. He says, if price gives me a pullback to a good level, I will look for an entry. If price does not come back, he does nothing. He does not chase. He does not panic. He protects his capital. This is the difference between emotional trading and professional thinking. Now here is a simple checklist before entering any trade. Question number 1. Am I entering after a big move? If yes, be careful. Question number 2. Is price close to support or resistance? If yes, check if there is enough space. Question number 3. Is this entry based on a plan or based on fear of missing out? Be honest. Question number 4. Where is my invalidation point? In simple words, where will I exit if I am wrong? Question number 5. Is the potential reward worth the risk? If the trade has small reward and big risk, skip it. A good trader does not only ask, can this trade win? A good trader asks, is this trade worth the risk? This mindset is important, because trading is not about taking every trade. Trading is about taking the right trade. Now let's talk about a very common trap. Breakout chasing. Many beginners see price break a level and immediately enter. But sometimes, the market creates a false breakout. Price breaks the level, attracts late buyers, then quickly returns back below the level. This traps beginners. To avoid this, do not trust every breakout immediately. Look for confirmation. Look for a retest. Look for volume if available. Look at the candle close. Ask yourself if price has enough space after the breakout. Do not enter only because price moved fast. Another common trap is revenge trading after missing a move. A beginner misses a strong move. He feels angry. He thinks, I should have entered earlier. Then he enters the next move without proper analysis. This is dangerous. Missing a trade is not a loss, but chasing a missed trade can become a real loss. Remember this sentence: a missed trade is better than a bad trade. You must train yourself to stay calm when you miss an opportunity. The market will always give another chance. Now let's summarize the lesson. Many beginner traders lose because they enter too late. They chase big candles. They ignore support and resistance. They do not wait for pullbacks. They trade because of FOMO. They enter after the move is already obvious. To improve, you must learn to wait. Wait for structure. Wait for good levels. Wait for a better price. Wait for confirmation. And most importantly, know when not to trade. Before your next trade, ask yourself, am I chasing the market? Is my entry near a strong level? Do I have enough space for the trade to move? Is my risk controlled? Is this a planned trade or an emotional trade? If you cannot answer these questions clearly, do not enter. Waiting is not weakness. Waiting is discipline. In trading, patience can protect your account. The goal is not to enter every move. The goal is to enter the right move at the right place. Do not trade because you are afraid to miss out. Trade because you have a clear reason. Do not chase the market. Let the market come to you. Important disclaimer: this video is for educational purposes only and is not financial advice. Trading involves risk, and profits are never guaranteed. Always do your own research and never risk money you cannot afford to lose. Subscribe to Mr. SHEKO Trading for more trading education, technical analysis, price action, risk management, and trading psychology lessons.